Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Listen, Charles, thanks so much for taking the time today to go through some really interesting information, and what I'm going to call this kind of behind-the-scenes information, because what we've talked about leading up to this call, we had a discussion about what is it that allows you to find the companies that you find. I mean, because one of the things I've experienced with your investments, I've experienced that you've got great companies, probably some of the best companies in the world, and they've made lots of money for us. Now, I'm not saying that because I'm saying, it always happens that way, but it surprises me that a company that is so large is able to produce an investment return of such a high level when the company isn't growing as fast as the return was. And in our conversations, it really came back to more to do with, well, you have to buy the company at the right price in order to make the right return. So there's a separation between the company's growth, but then the actual investment performance that you as the investor get when you invest in that company at the right time. So I was hoping today we could just go through a bit of a story as to, one of the companies that you own currently in your portfolio, and you can maybe just give us a walkthrough what it was that allowed you to identify the company. What was the flag or the thing that made you aware of that company, that made you start looking further into it, and then just take us through that process that you go through to determine, this company for these reasons is a good company to buy, and these are the parameters that I'm going to use to buy it. So I was hoping you could just sort of walk me through that a little bit.
Yeah, sure, Scott. First of all, the overall way that I look at the market is we know that we're looking for companies that we understand, and we want to buy them at the right price, which is a low price.
Okay.
So to look at companies that we understand, we want some predictability in the businesses. And what I do is on a day-to-day basis, I go through many sites and different support groups that I have and different companies that I use. And basically could go through most of the companies in the market, whether it be 19,000 companies here or in Europe. And basically, and over the years, you get to understand the businesses that you like. So because I want something that has some predictability factor to it, then that narrows the market very much for me, and probably gives me maybe 30, 40, or 50% of the market, or even less. So that allows me more time to go through and look at things that are going on. And one of the things that I do is I have a service where I monitor probably 75 of the top investors in the world. And I know what they buy, I know what they sell, I read all about all kinds of things. So you're sort of bouncing back and forth. And I looked at IBM, and I've looked at IBM over a period of time, and I didn't have any room in my portfolio. I've got 20 companies, and I don't want to sell one just to buy another one unless there was incredible value there that you're forced to. So I started looking at IBM, and I was noticing that IBM was buying stock back.
Okay, so hang on one second. So this is an interesting point you just made there, because you made the point earlier, just a few minutes ago. You said you want to find companies that you like. Now, you have your definition of a company that you like, and we're talking strictly from an investment standpoint. So maybe if you could expand on that term, a company that you like. What are companies that you like versus companies that you don't like?
Well, the companies that I like have to meet a certain criteria, and one is to be able to understand how the company works, and to have be more on the predictability continuum than something that is really cyclical.
So what do you mean by predictability?
Predictability. So that's how you identify a company's moat. And a company's moat, from IBM's point of view, there's a few things that I noticed. First of all, the management. There's four things. There's management, there's the moat, there's the requirements for a good business metric, meaning the company's really great, share purchases, and also the management's ability to be able to execute on what their plan is. So, for example, when you do a deep dive or you get more into IBM, you start noticing that they work on 5-year plans.
Okay.
And when you start going in and you start looking at the 5-year plan, so one was one's coming up. It was 2011 to 2015. So in 2015, if their plan, and I'm looking at how their plan was executed the last 5 years, and I'm looking at how it's been executed so far with this 5-year plan, the roadmap actually ending in 2015.
Okay.
So the company, so that's the management aspect. Now the moat is not a barrier to entry to a company. What the moat is, ability for the company to have predictable revenue.
Okay.
Instead of a company going up and down all over the place, you don't know what's going on. So I want something that has a lot more predictability to it, because that makes it a lot easier projecting growth of the business down the road. So, for example, 5-year plan, just from IBM, if you start going through it, you look at it, they're looking at $50 billion in share repurchases. You're looking at, the other thing is they bought back 5% of their stock.
So was that one of the real things that said, hey, wait a minute, that's
one of the things I noticed.
Yeah.
But what I also noticed is Warren Buffett bought 5% of the stock.
Okay.
So now you notice that IBM is going to be buying another 5% of the stock.
Right.
So the thing is what happens is the shares outstanding are decreasing, which means the value of the business is increasing to any existing shareholder.
Right.
So it's a case of making money without doing anything.
Okay. So now
they bought back $50 billion in repurchases. They paid $20 billion in dividends, and they're going to earn $20 a share by 2015. They've got $100 billion in free cash flow, and they're spending $20 billion on acquisitions. This is a tremendous momentum of a company that has a strong moat, which is predictability, or closer to the predictability continuum.
Right. Okay. So now you've got a company that has proven that they've got good management and that they've got a track record for, I guess, meeting their plan, setting a plan and meeting it, and they're on track for their existing plan. You've got a company that has a moat around it because the predictability of the income, I guess, or is it income or profits? But the predictability of the business
revenue,
going forward,
revenue.
Okay,
revenue. So they don't make money 1 year, lose money the next money, then lose money 2 years, then make a lot of money.
Yeah, it's just consistent. Okay, so there's a tremendous amount of consistency. Okay, so that's interesting. And then, okay, so you've got the management, you've got the moat.
Well, the actual metrics of the business, which was and the actual management's ability to execute the plan. So they've executed. They're right on in terms of executing their plan. So this is a tremendous opportunity for the good management to execute what the plan is. Okay,
so now you've got a business that meets your criteria of you like it. So when do you buy it?
If we go through, you'll notice up on the screen here, I've got this metric for IBM.
Okay.
And now, given that we understand IBM, we like IBM, and before we're going to buy it, we need to have some certain metrics in place. And one, I use this new Constructs, which is a company out of Nashville that has the ability to reconcile GAAP accounting with the economics of the actual business. In other words, what they do is they go through all the financials of the company, and they go through the footnotes of the company, 100 or 150 pages of footnotes. And what they want to do is they want to scrub all the numbers, they want to clean them out, and they want to bring them back onto the balance sheet or onto the financials to give you a very clear and true picture of the actual economics of the business, not the accounting economics of the business.
Right. So if you look at the annual statements, basically you don't trust them. Okay, so now we've got the metrics, some of the metrics that you're looking at on the screen here, and you basically said that okay, you don't trust the financial statements, you don't trust the annual report. You then hire a forensic accounting firm, for lack of a better term, to do a deep dive and to deconstruct everything to give you the real numbers. I guess.
Fundamentals.
Fundamental. Okay.
What we're trying to do is we're trying to get to the real economics of the business.
Okay.
How much was invested in the company? What was the cash return on all the invested capital in the business? And what's the cost of capital? And at the bottom, what is the net profit after tax scrubbed clean?
Right. Okay. So
that include all the accounting conventions that most you do not see, which is why you have to go through the footnotes.
Right. So so that makes a lot of sense. So you do the deep dive, and then so now you say, okay, I like IBM. It's a company that I think has a lot of predictability. I like the management. You've even answered the question where if you think, well, if they replaced all the management, could they still, be good? I mean, try to blow the company up, and we've talked about that a little bit in the past. Is there anything that could take this company down? And I guess the answer to that would be, in this case, no. I mean, it's a pretty solid company for all intents and purposes. So that qualifies as a company that you like. I'm not going to say you buy it at this point, because buying and liking are two different things.
What we're trying to do is we're trying to identify a margin of safety.
Oh, okay.
All I want a margin of safety. In other words, I want to buy the business at a price that even if something happened, we've still got way more protection.
Oh, okay. So a downside protection.
So I'm trying to get the odds on my side, so I can go and I look at the business, and the business is very profitable based on real scrubbed clean numbers from the economics of the business, and then we come up with a price.
Okay.
And that price versus the market value of the stock creates a margin of safety or a problem.
Right. Okay, so what is...
Because what we're trying to do is we're just trying to bet. What we're trying to do is we're trying to find a good company like IBM that is mispriced in the marketplace based on the economics of the business.
Right, okay. Okay, so then what are we seeing here then? So you've done all those calculations, and you've done that on the current example of IBM, because this is a company that's fairly recent, I think, into your portfolio. So what is it about IBM that is making now, and I say now because it's just at the time of this recording, now is the right time to be adding it or acquiring it or including it in your portfolio?
Well, all things being equal, if we have a margin of safety and we like the business economics, so they have to be improving. They have to be making money, and we have to include the cost of capital. And there has to have some predictability in there based on the past. Mm-hmm. So if we like that, one of the areas that we look at is, if you see here where my cursor is price to economic book value.
Okay.
So when we see 1 here, what that means is, if you took the operation, this is economic book value, not accounting book value.
So this is your scrubbed down number.
Of the company. This is economic book value.
Right.
So if we looked at 1, that means that if the company was sold today for the operational value alone of the business. So if we look at IBM, it's trading at $204. Mm-hmm. Then the operational value of the business is very close to $204.
Okay.
That means that's what the business is worth to a prudent businessman.
Okay.
So if Buffett wanted to go and buy IBM and say he could buy IBM and he could take it private, then he wants to buy it around as close as he can or below what the operational value of the business is. That identifies the margin of safety. Depending on the quality of the business, so you have IBM, which is a very high quality business, what you want to do, all things being equal, is to buy it as close to the operational value. This is a terminal value. This is a non-growth number. This is just the terminal value of what the operation is worth to a prudent businessman. So what we're doing is we're looking, depending on the business, trying to buy it maybe around 80 cents to maybe $1.20 when the economic book value is $1.
Okay, so in around that range.
We have a range there.
Okay. So now what this is then telling, and I'm just going to sort of summarize it a little bit, this is then saying that this particular, IBM right now at this price on this date with the economic book value, being at that 1 ratio is really not taking into account any of the future profits.
Exactly. In fact, here's what it's saying. At $1 for operational book value, what the market price is saying at $204, what the market price is saying is that IBM will never make money and it won't grow.
Okay.
And it won't do that because they're paying, actually it might be around 98 cents rather than $1. Mm-hmm. But my point is that if you're buying it for $1, you're buying no growth. So what you're saying is it's not going to grow.
But in reality, we kind of have a history of seeing that IBM has some growth and it has good management in it. So it's kind of a ridiculous price.
Well, it is ridiculous when you consider the return on invested capital is 16%.
Oh, right.
So when you're going into IBM, if you looked at it from that point of view, what you're doing is you're buying the company with no growth.
Right. And the reality is that we know that there is going to be growth. So as the growth comes, then the market's going to say, hey, there's growth in that company. The price is too low, and the market's then going to say it's worth more.
And the idea is to buy companies that have increasingly higher quality of growth. So the chances of IBM not growing is probably slim to none. Now, why the market? So the question is, why would the market price the stock for no growth?
Right. Okay.
The market has no idea what the growth is. The market is just a market price. Right. And what we're trying to do, this is just what the market is telling you what it's worth by the market price.
Right.
So the market doesn't know, it doesn't look at IBM and know what IBM's doing, or I guess there's people selling IBM not because IBM is not growing. They're selling IBM because the market is run by momentum, emotional people. Mm-hmm. And what we're trying to do is we're trying to buy a really good business, and what we're doing is we're trading off the market price to what the real value is.
Right. So in essence, the research and the analysis that you've done is basically saying you know more your business, which in this case is IBM, than you feel the market does. Because the market's saying it's worth 204. You've done all the math and saying, yeah, it's worth 204 if you don't think the sucker's going to grow. But because we feel very strongly and we've got history and proof that it's growing and it's got great management and whatnot, that's a ridiculous price to be at. So therefore, that's, and correct me if I'm wrong, then that would be one of the main reasons why you're saying, hey, right now is not a bad time to be buying or IBM and be including it in your portfolio, because you do so, you're going to capture all that future growth.
It's not that it's not a bad time. It's a generational buy.
Okay.
Why do you think IBM's buying back 10% of the stock? Because they think it's overvalued?
Right.
They know this. Of what IBM would love to do, and what Warren Buffett would love to do, and me love to do as well, is make sure this thing maybe goes down instead of up.
Right, so you can buy more at a
I can buy more.
Yeah,
exactly. So I like the thing to go down to 180, 190, and I could buy more, and I can buy more. And IBM would be buying more and more as well. So what it's doing is it's creating probably maybe an 8 to 9% return based on repurchases alone by insiders and by the company.
Right. And so when you recognized IBM and initially did that, I mean, this isn't just brand new analysis that you've done. You've been doing this analysis on IBM for a bit. I mean, when did you see it as something? Hey, this is we're going to start including it in the portfolio.
Well, what I did is I'm doing more and more analysis on it. And the thing about this business and buying companies is you need some patience. Mm-hmm. And you need some humility. So just because you see something, you're not going to run out. You got to get into it. You got to taste it. You try and blow it up. You try and understand what's going on, especially from the management point of view. Mm-hmm. And I have 20 companies. And what I did is I wound up selling Nike.
Oh, okay.
I sold Nike and bought IBM.
Well, that's, you know what we'll do then? Maybe we'll have another chat on another discussion on why you sold Nike. I mean, geez, Nike, for all intents and purposes, you say the term and everybody has this vision of a great company, but there's a reason why you sold it.
Yeah, expectations are too high.
Yeah, okay.
And you know what? I might add, now doesn't preclude you can't buy it back later, but the idea is that when the market gets out of whack, then we give it to them when the expectations are so high. So
Right.
we want to buy low expectations and sell high expectations. So in order for me, and then I look at maybe selling, well, let me put it this way. We'll get into it later on the sell call. But in order for me to sell IBM now, at my criteria, the stock would have to be 300.
Oh, okay. Wow. Okay. So that's
So 1.5 of economic book value would put $300 onto the company.
right. Right.
And that's not a wow overextended expectation for a company like IBM either.
Yeah. Yeah. Well, that's interesting. So, well, I mean, I'm glad you went through this with me because it just sort of gives us another taste for what it means to allow, or what it means to say yes to purchasing a company in a portfolio. I mean, this is for anybody who's wanting to manage their own account on their own. You know, if they're not going through this type of analysis and doing, having a certain level of recognition about what's available in the marketplace, what's going on in the marketplace, so sort of an ear to the market, to recognize that, hey, IBM, they're buying back their own stock, and the more you do a dive into it, and you've got your services in place that even say, you know what, you're looking at IBM, they're buying back their own stock, and guess what? There's some other big Hall of Famers that are also buying IBM. So it just there's certain things that you have put in place that give you the tools, so to speak, to make the right decisions for the right reasons. Nothing about this is
40 to 50% of people don't make money in the market for a reason.
Yeah.
They don't understand the business they're buying, and they cannot evaluate the business from a prudent businessman's point of view. And there are companies out there that are trading at economic book value at 1, but the dynamics and the fundamentals don't look great.
Right.
You can also see a company that's had a really good run. Let's say, for example, HBQ, Hewlett Packard, who's had a big run. And all of a sudden, now the company's on decline. But if you looked at it, and you looked at the economics of the business, they don't look that bad. But when you do the deeper dive, you got to go in and look at the deeper dive and say that the actual return on invested capital is waning.
Right.
So what we want to know is what the trend is as well. So there's businesses out there that look great. They're called value traps.
Right. Okay.
So people say RIM is a good buy now because it went from 128 to 11, or companies cut half its revenue or half the stock price. Those mostly are value traps than anything else. They're not they're not growth businesses that we really want.
Yeah, and not to say that it's not necessarily a good business from what they produce and the product that they create, but from an investment standpoint, I would think that a company like RIM or a company like Apple doesn't necessarily meet the definition of your term, a business that you like.
I could not buy them anyway because I can't price them. I can't evaluate them.
Why can't you price?
Well, remember we talked about an economic moat.
Okay.
Well, an economic moat is something understanding the business and to have some predictability factor of making money over time. The problem with the technology companies, you're going to go buy a technology company, and the next day they're out of business, or look at what happened to RIM.
Right.
So I have no ability at all to look out 5 minutes and have any kind of consensus on what's going on with that business because nobody understands the business. So from an investment point of view, you're going to get killed.
Right.
Which is why you don't buy commodities either. I have no idea what potash or gold's going to do, or oil. I'm trying to buy a business. And what we're trying to do is we're trying to buy really prudent businesses that the market price has a very low expectation for, which gives us the price that makes it attractive. When we buy that and the company keeps growing and it eventually we're going to have to sell the IBM like we sold Nike. So if I bought Nike at $70, I sold it at $108 because the market expectation went from this company is never going to make a dime to this company is going to grow twice as fast as it has over the last 10 years for 10 years.
Right. Yeah.
So that's built into the stock price. In other words, when I sold Nike, what would have to happen, it was over 5 years. So you'd have to take what the compound revenue gains were for the last 5 years. You'd have to double them for 10 years before you got to the place that the operational value was worth $108.
Right. Yeah. So it didn't make sense. Well, that's great. I mean, well, you know what? Let's do that. Let's do this again. Let's have another call and perhaps go into the why you sold Nike, and we can have a bit of a discussion on that, because obviously the numbers would probably look a lot different than what we're seeing for the numbers on the screen here for IBM. And it's interesting. I appreciate sort of the perspective on things, because you talk about the numbers, and just because it says 1 as the economic book value ratio there doesn't necessarily mean that just because it says 1, it's the time to buy a company, because you then have to look at the fundamentals of the company and all the other things that go into it. So it's this isn't something that anybody can do. It is something where you've got to have a certain level of wisdom surrounding your decision-making process. So, well, that's great.
Yeah, you have to be able to evaluate the business. So if you wind up buying a fund, or people wind up doing it on their own, or in fact, most brokers do not do this.
Right.
Because of the reasons why we said before, they're momentum players or whatever. But if you look at the Hall of Famers, if you look at the people that make money consistently over the longest period of time, they understand what they're buying, and they're cheap in terms of the price they're going to pay for it, or else they don't buy it.
Yeah. Again, and that doesn't mean it's a bad company. It's just not the right time to buy it.
I waited 8 years to buy Walmart and Coke and Home Depot.
Right.
They're great businesses, but they were way too expensive. So when they got to the point that I thought they were cheap enough, it took me 8 years, I bought it, and then they doubled.
Yeah. You know what? Then we've got a lot to talk about on future calls. So let's do that. Let's see if we can't line up a few more of these, because I think a lot of the people who are listening in would find them of tremendous value. So, well, listen, I really appreciate you taking the time today to go through this.
Thank you.
Yeah, and we'll talk to you again soon. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment, and we'll respond directly online. If you would like to take advantage of a free, no-obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter, twitter.com/IronShieldCFP. Like us on Facebook, facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.